Hello everyone, my name is Gabriela Alfonso, and today we're diving into a key concept in finance and accounting called leverage effect. The agenda for today is a brief introduction, a general definition, related key concepts, and also how they relate to the cash flow game, an example, the difference to neoclassical approach, a conclusion, and the references, of course. Have you ever wondered how some companies can grow so quickly and how some of their investments can bring in massive returns, while others can simply result in significant losses? Whether you're managing people, advising on organizational strategy, or leading in a global context, knowing how leverage works can give you deeper insights into decision-making, risk-taking, and both financial and human behavior. Okay, so from an academic perspective, different authors explain the leverage effect as the one that occurs when a company uses debt or leverage to enhance both the potential gains and risk of an investment. So by increasing the amount of borrowed money relative to its own equity, the company amplifies the volatility of equity returns, which makes both profits and losses more significant. In other words, this effect involves borrowing money to try to earn higher profits. If things go well, the gains are bigger than if you had used only your own money. But if things go badly, the losses can also be greater because you still have to repay the debt. This also implies that as a company borrows more money, its equity, meaning the value that belongs to shareholders, becomes more sensitive to any changes in the company's assets. Let's first discuss two key concepts that are central to understanding the leverage effect. First, leverage. This refers to the use of a borrowed capital, meaning debt, to increase the potential return of an investment. As mentioned in class, volatility is the degree to which a company's equity returns fluctuate. This means that higher leverage increases volatility because any changes in the company's assets value have a more significant impact on the equity holders. Now, the leverage effect is one of the possible variations that could be done for the game. In this case, it may be in one of the years where it's not apparently possible to take all the orders, the company could decide to borrow money from the bank and take the risk. Okay, now let's look at this example. In option 1, you invest 100 euros of your own money. If the value increases by 10%, your investment grows 110 euros. Giving you a 10 euro profit. That's a simple 10% return. Now, in option 2, you borrow 50 euros from the bank and invest 50 euros of your own money. If the project also increases by 10%, then the total value is still 110 euros, but you owe the bank 50 euros. After paying that back, you're left with a 60 euros in equity, which gives you a 20% return. However, remember that leverage works both ways, so if the project value had fallen 10%, you would have lost 10 euros from your equity, resulting in a 20% loss. Now, traditional economics, also known as neoclassical approach, assume that companies act rationally, so they would only take debt when expected returns are higher than the cost of borrowing. Instead, behavioral finance shows a more realistic view where decisions are actually driven by psychological factors like overconfidence or loss aversion. For instance, overconfidence can lead managers to take on excessive debt because they're too optimistic about the future outcomes. On the other hand, loss aversion can, for example, cause managers to avoid debt entirely even though it might benefit their company. They fear the loss more than they appreciate the potential gains. In conclusion, the leverage effect isn't just about increasing profits through debt, it's also about understanding the human factors that drive decision-making in organizations. For those of us in psychology, HR, and international management, the leverage effect offers a clear example of how cognitive biases like overconfidence or loss aversion can lead to risky financial behaviors and how these choices can affect broader organizational outcomes.